Welcome back to another explainer. Today, we're diving into a genuinely fascinating financial paradox surrounding Jackson Financial, or JXN. In the world of stock analysis, things usually make intuitive sense, right? Good numbers equal good stock performance, and bad numbers equal bad performance. But every so often, we stumble upon a paradox that completely breaks all the standard rules. Take a look at this massive contradiction. On one hand, we've got absolutely brutal valuation metrics, like a wildly negative price-to-earnings ratio and a negative return on equity. But then, on the flip side, a staggering 3-year return for investors of over 272%. By standard textbook definitions, this company should be a total disaster, yet the returns are saying something completely different. Which brings us to the core mystery of today's explainer. How exactly does a stock with such seemingly terrible top-line numbers end up being an absolute champion for its shareholders? It's a question that completely upends how automated systems filter for stocks. And to answer it, well, we have to look past the surface-level data.
Section 1. Unpacking the price ratios. The ugly headlines.
At first glance, JXN's price-to-earnings ratio sits at a terrifying negative 321.58. For most automated algorithms and standard stock screens, that is an instant do-not-buy signal. It usually implies a company in deep, deep financial distress. And the pain isn't just isolated to one metric either. We're looking at a return on equity of negative 0.17 and a return on assets of negative 0.01. On top of that, over the trailing 12 months, they are reporting a net income loss of $17 million. If that wasn't enough to scare you off, their 3-year compound annual growth rate for revenue has actually shrunk by nearly 16%. On paper, using traditional accounting rules, this looks exactly like a shrinking, highly unprofitable business.
Section 2. A history of massive returns. Define the headlines.
But here's where things get really interesting. The reality of the stock price tells a completely different story. After a slight dip of about 11.5% in 2022, which honestly aligned with the broader market trends that year, the stock just absolutely exploded. It gained over 57% in 2023 and followed that right up with an incredible 76.45% gain in 2024. These are the kinds of numbers tech investors dream about, right? But it's coming from a financial company with negative accounting earnings. Zooming out even further, long-term investors have seen phenomenal 5-year total returns approaching 360%. And the momentum hasn't stopped. Moving into the data for 2026, we are already seeing a year-to-date return of almost 9.5%. So clearly the market knows something that the basic net income line on an income statement is completely missing. Section 3. The free cash flow engine. Uncovering the clues. So what exactly is driving this explosive growth while those headline earnings stay aggressively negative? Well, the secret lies right here: free cash flow. Unlike net income, which, let's be honest, can be heavily skewed by non-cash accounting charges like depreciation, amortization, or complex financial derivatives, free cash flow is the pure, unadulterated cash the business actually brings in to reward its shareholders. And this is the absolute crucial point. Over the trailing 12 months, despite reporting a $17 million accounting loss, Jackson Financial actually generated over $5.7 billion in pure free cash flow. This right here is the smoking gun of our mystery. The business isn't bleeding out at all. It's an absolute cash-generating machine. To put that $5.7 billion into perspective, we just need to look at the free cash flow yield, which comes out to an unbelievable 70.17%. Think about that for a second. That means the cash this company generates in a single year is equal to roughly 70% of its entire $8.2 billion market cap. It is almost unheard of for a company to generate cash at this scale relative to its price. When we evaluate the stock based on this cash reality, rather than those rigid accounting earnings, the valuation completely flips. The price-to-free cash flow ratio drops to a microscopic 1.38. So instead of trading at a massive negative PE, it's actually trading at less than 1.5 times the actual cash it brings in. Suddenly, that 270% stock surge makes perfect sense, doesn't it?
Section 4. Dividends and debt ratios. The safety check.
Now, any smart financial detective is going to ask, okay, but is management using this cash responsibly? Well, JXN is heavily rewarding its shareholders. Not only are they paying a very solid 3.11% dividend yield, but they've consistently grown that dividend at double-digit rates. We're talking over 12% in the last year, over 13% annualized over 3 years, and an impressive 14.5% annualized over the last 5 years. That is a very aggressive, very consistent return of capital to investors.
And here is a massive contrast. While standard accounting metrics flag their payout ratio at 100%, which normally screams that a dividend is unsafe and about to be slashed, the cash reality is far different. Because of their massive free cash flow, they actually use less than 4% of their cash to cover that generous dividend. Less than 4%! That dividend is incredibly safe.
Furthermore, we need to make sure they aren't achieving these wild returns by taking on reckless amounts of leverage. And the data shows their balance sheet remains incredibly secure. They have a very conservative debt-to-equity ratio of just 0.20. So they are generating literally billions in cash without leaning heavily on borrowed money.
Section 5. Evaluating the fair value. The final verdict.
All right, so we've uncovered the hidden cash flow engine, and we verified the safety of their dividends and their balance sheet. Bringing it all together, we need to look at the margin of safety. This is how we ensure we're buying at a steep discount to true intrinsic value, protecting our capital from unexpected downturns.
Driven by that unbelievable $5.7 billion cash flow, our discounted cash flow models reveal that JXN Financial boasts a jaw-dropping margin of safety of nearly 97%. I mean, it is exceptionally rare to see a margin of safety approaching 100% in today's market. The disconnect between the market and the math here is just staggering. While the current stock price sits around $115, the discounted cash flow models, based entirely on that pure cash they generate, place its true, fair value at over $3,500 per share. And that right there is why the stock has been compounding at such high rates. The market is slowly waking up and desperately trying to close that massive valuation gap.
Which leaves us with this final provocative thought to ponder today. When a stock like JXN Financial can quietly generate billions in pure cash, pay double-digit growing dividends, and see its stock skyrocket 270% despite screaming red flags on traditional screeners like a negative PE ratio, is it time we stop trusting the traditional headlines? It's pretty clear that true value investing requires digging much deeper into the cash flow statement. Thank you so much for joining me to solve this mystery today, and I highly encourage you to keep questioning the data.